Hey everybody, Spartan here from SpartanTrading.com. Today I wanted to talk to you guys a little bit about options, primarily some options basics. And today I wanted to cover just reading a options table. So an options table or options quotes, whatever you want to call it, basically is a breakdown of all the options, the contracts available at the expiration. And it gives you a whole bunch of different things, the open interest, obviously the bid and the ask, the price of the contract itself, implied volatility. There's a lot of different things you can put up on the table itself, but I wanted to talk a little bit about the basics. Primarily just the last price, which is the price of the contract, and open interest. So what is a option and how do we kind of read it? The strike is what the price of expiration on that contract would be. So if I had $180 calls on Apple, at expiration I would have the ability, but not the obligation, to purchase 100 shares at $180, which is, per contract, given that strike. So if I was looking at, for instance, a longer dated option, April 18, 2019, so about a month away, and I was looking at $185 calls, I would have the ability per contract to purchase 100 shares on April 18th, 2019 at expiration if the price of Apple was above the contract. The reason why it would have to be above the contract's price is why would you want to purchase or why would you want to pay more at expiration if the price was below it? It wouldn't make any sense. So that's how the strike and the expiration work. In terms of on the put side, puts would be the equivalent of being short the underlying asset, which in this case would be Apple. So at expiration, if I was looking to grab some puts, 185s, and the stock price was $175, at expiration I could be holding 100 shares short if I had one contract on April 18th, 2019 if I let those puts expire in the money. So obviously calls would then be bullish, being long the underlying asset. Puts would then be being short the underlying asset. The interesting thing is we see a lot of buying of calls or puts, which can dictate the direction of a stock, because people are betting that the stock will be lower than the price at a specific expiration or higher at a specific expiration, which can basically add into the momentum or direction of the stock. People can and will buy the underlying asset based upon the sweep. If it's big enough, they will definitely, buy on it. So that brings me to the next thing to be looking at is the volume of the contract. If there's a high volume on those contracts, then a lot of people are interested in owning them. And if there's more volume on obviously the call side than the put side, then people are thinking that by that date, it can go higher than that strike. Vice versa, if there's more put volume, then they're obviously looking for that asset to be lower than the price at that date. So that's kind of a little bit of options basics there. The last thing I do want to touch upon is just the open interest. And this is just the amount of people that are trying to buy or sell the contracts. If one buyer and one seller meet in the middle, then that removes one value from the open interest. So in this case, there's a whole bunch of different people at 180 on April 18, 2019, trying to buy and sell the contract simultaneously, but not meeting in the middle at a certain price. So that's how many open contracts there are. More open interest means there's more liquidity in the options, which means the spread between the bid and the ask should be smaller. When you see not a lot of open interest and not a lot of volume, the spread between the bid and the ask will be quite wide. So I just wanted to go over kind of how to read the actual options table. If you guys do have questions, please feel free to reach out, Spartan@SpartanTrading.com, or you can visit our website, SpartanTrading.com. Thanks guys and have a great day.